Well, the Bank of Canada is announcing its policy rate later today, and the Federal Reserve will also be making key announcements to end the year. Here to preview those announcements with predictions and analysis is Stephen Brown, Deputy Chief of North America Economist at Capital Economics. And Stephen, thank you very much for joining us.
The pleasure.
Let's start with the BOC. What can we expect? No real surprises, is there?
Yeah, well, no real surprises on the policy decision. So they did indicate in October that they were likely to keep interest rates unchanged from here. I think what we'll be looking out for is just any reaction from the bank to the recent strength of the economic data. So we had a big upside surprise to Q3 GDP growth, but that was mainly due to a slump in imports. So not really showing anything about underlying strength. But much more strikingly was the big drop in the unemployment rate we had in November, taking it down by 0.4 percentage points to 6.5%. Now, that is still elevated, but it does suggest maybe the economy is using up slack in the labour market a bit more quickly than the bank anticipated. And indeed, the market is actually now pricing in interest rate hikes next year. So it'll be interesting to see if the bank pushes back against that at all.
And with that data, how much of an influence the GDP, we talked about it was a slump on imports, but the unemployment rate, a lot of those jobs were also part-time, if I remember correctly, some of the numbers. How will they be treating that if it was more part-time jobs? How will they react to that?
Yeah, there's always quite a bit of volatility in the survey. We don't tend to put too much weight on the part-time, full-time mix. But I think the big picture is that we're not really seeing signs of strength in labour demand. So yes, the labour force survey has shown 3 quite strong gains for 3 months running now, but it's partly due to this technical quirk where it's taking a lagged calculator for population growth. So basically the labour force survey is scaling up population based on what immigration was doing almost 12 months ago. If you look at the alternative survey of payrolls, employment and hours called the CEF, that actually shows basically 0 jobs growth in recent months. So that's probably the more realistic indicator of labour demand. But the issue for the bank is that we've had the government kind of double down on this idea that it wants to reduce temporary migrants in the country, which could result in a decline in the population next year. Indeed, the Bank of Canada told us last time in October that it thought the break-even employment rate, so that's the rate that keeps the unemployment rate unchanged, could be as low as 5,000 per month. So the economy really doesn't need to create many jobs if that is the case, just to keep the unemployment rate steady. And it means we could be heading lower on the unemployment rate quite quickly next year. And then obviously at that point, the bank would start becoming a bit more worried about wage pressures. Now, to be clear, we're nowhere near that just yet, but it will be interesting to see if the sharp drop has changed the bank's calculation or whether it just thinks this is a bit of a bounce back from the tariff shock earlier in the year.
Going to the U.S., what data points have you been looking for in the absence of some of the government data that you'd usually rely on?
Yeah, I mean, we've got a whole host of alternative indicators for the US. So for the labour market in particular, we've got the ADP measure of private payrolls. There's a couple of other similar measures available. And then although we haven't had the official employment data, we have now had kind of timelier measures such as the initial jobless claims data. So those have all been, pretty much under control, not consistent with a pickup in labour demand, but not really pointing to a deterioration either. And then most recently, this week in particular, we've started to get a bit more data. So the job openings, the official job openings data or up to October looked quite positive. So again, nothing to really write home about, but certainly a bit of an improvement compared to where we were just before the government shutdown. And then some of the survey indicators too, showing maybe a modest pickup in labour demand. So I don't think we're out of the woods yet. We're going to get the October and November payrolls data next week, and October is going to be very weak due to federal worker layoffs coming through. But I think by the first quarter of next year, we should be talking a bit more positively about the US labour market.
And then how will that play in for next year, for 2026? We're looking at a new Fed chair, and what kind of a factor will that be on decisions they'll be making?
Yeah, I think, we view this again through the lens of what the break-even employment rate might be for the US. We estimate it's probably about 50,000. There are some estimates suggesting it's as low as 30,000 now due to the tightness of the immigration restrictions. But we've actually been pretty close to 50,000 if you take out those federal layoffs that should, they won't be a story anymore in 2026. So we're already close to that break-even. So although the unemployment rate has been inching higher in the US, we expect it to stabilize next year. Now that, the Fed kind of has it stabilizing too at about 4.5%. I think the new Fed chair, most likely Kevin Hassett, could still make the case that even though the unemployment rate is stabilizing, we've seen it go lower, in particular just before the pandemic, it was below 4% without any obvious upside risk to inflation. So I think the next Fed chair will still try and make that view. But again, it's still just one of the 12 votes on the FOMC. We know that the regional Fed presidents are the more hawkish kind of members of the FOMC at the moment, and they're still going to be pushing back. So kind of the Trump contingent, as it were, even if Trump is successful in replacing Lisa Cook in the new year, would still be just a small a large minority on the FOMC, maybe up to 5 out of the 12 participants. So they could still be outvoted. So it's not guaranteed that we get lower rates, but certainly we expect the Fed to cut today and then at least one more under the next Fed chair next year.
Will the timing of the next Fed chair announcement play any role into market volatility, or is that something that is sort of a non-issue in your view?
Mostly a non-issue. So I think because it's pretty clear that Trump is trying to influence the Fed, we've already seen both the Board of Governors members and the regional Fed presidents become a lot more vocal in recent months, particularly since Stephen Myron joined the board back in September. So I think, the conditions are already kind of reflecting the fact that power is on the way out. Now, the new Fed chair announcement, it seems unlikely to me that we'll get a big market reaction just because, well, assuming it is a Hassett, just because the betting markets suggest that he's got about an 80% chance of getting the position. So it would be quite unusual for the market to suddenly be worried. But certainly, this repricing we've seen at the kind of a longer end of the yield curve, we doubt it's entirely due to kind of concerns about Fed independence again, but that's probably part of the reason.
Okay, Stephen, we're going to have to leave it there, but thank you very much for joining us.
Okay, thank you. It was a pleasure.
Stephen Brown is Deputy Chief of North America Economist at Capital Economics.